All right. Well, hello, everyone. To our first time guests, welcome. And to those who came back for more real world financial advice for free, welcome back. My name is Daniel Leitner, and I'm a financial advisor here with Hendricks Wealth and Estate Management. And I will be the one guiding us today in our journey of making sure you are protecting your family without overinsuring them. The other members of the Hendricks team that will be assisting me on our journey today are Jim Madel and Tom Anderson. All right, so jumping into the presentation now. Today we are going to be talking about insurance, but not from a product or a sales perspective. We're going to be talking about insurance as a planning tool, specifically how to protect your family without paying for coverage that you don't actually need or that competes with your other goals. This is designed to be an educational conversation. I will just be covering principles you can apply to your own situation. In our experience, most families fall into one of two categories when it comes to insurance. The first group is those that are underprotected. They assume nothing will happen, or they know insurance is important but keep putting it off because it feels uncomfortable or confusing. The second group is those that are overinsured. These families were often sold policies based on fear or promises that insurance could function like an investment. At the end of the day, both of these situations create stress. But underinsurance puts your family at real financial risk. If God forbid something were to happen to you, your spouse, or whoever a major breadwinner is for your family, and you do not have insurance, there's a whole slew of additional problems that can get left on the family that stays behind. For instance, how are we going to pay the mortgage, buy groceries, or fund the kids' education? Now moving to overinsurance. Overinsurance quietly drains your cash flow and delays progress on things like getting out of debt, building savings, and investing for the future. Today is about finding the middle ground. Not too little, not too much. Very similar to the Goldilocks story. But I do not want to confuse those of you in our audience who know about our not too hot, not too cold Goldilocks investments we like to use. We just want to make sure you have intentional protection that fits into a bigger financial plan. The most important starting point is understanding what insurance is and what it is not. Insurance exists to transfer risk that you cannot afford to take yourself. It does not create wealth. It does not outperform investing, and it should never be used as a substitute for saving or investing. When insurance is used correctly, it provides stability during a worst-case scenario. It gives your family time to grieve, adjust, and make thoughtful decisions without financial panic. When insurance is misused, it becomes expensive, confusing, and restrictive. Keeping this definition in mind helps filter out a lot of noise and marketing that surrounds insurance decisions. A helpful way to simplify insurance decisions is to ask one core question. What are we actually trying to protect? The goal of insurance is to not replace you as a person. The goal is to replace income, eliminate immediate financial pressure, and to protect dependents during a transition period. That usually means having sufficient coverage in place to replicate what your income would have bought at your current lifestyle for X number of years, and then covering outstanding debts while ensuring dependents are supported while they become financially independent. Once you define the purpose clearly, the amount of coverage becomes far less mysterious. One of the biggest myths in insurance planning is the idea that more coverage is always better. In reality, every dollar overspent on insurance is a dollar that cannot be used elsewhere. That means if you spend more than necessary on insurance, you will pay any debts you have slower. You will invest less in the market, or maybe even delay investing altogether. And those things lead to less flexibility for you and your family overall. Those are true costs of having too much coverage. Like we have said from the beginning, the goal is not maximum coverage. The goal is appropriate coverage that supports the rest of your financial life instead of competing with it. So how much coverage is usually enough? Instead of starting with a product, we start with questions. How many years of income would your family need if something happened tomorrow? What debts would need to be eliminated immediately? Are there young children or other dependents? What assets already exist that could help support your family? Insurance is designed to fill gaps, not fund every dollar your family might spend for the rest of their lives. When coverage is tied to a specific purpose and time frame, it becomes much easier to right size. And with that mindset, it often lowers premiums and provides you with more cash today to live your life instead of fearing for it. That brings us to term insurance versus permanent insurance. Term insurance is designed for temporary needs. It covers a specific period of time, such as working years or years with dependents. On the other hand, permanent insurance lasts for life and is significantly more expensive. While permanent insurance can have specific planning uses, it is very often sold in situations where term insurance would meet the actual need at a fraction of the cost. The key is matching the tool to the purpose, not forcing a permanent solution onto a temporary problem. Let me share a real-world example. There was this married couple in their late 30s, early 40s with two young children. One spouse earned the majority of the household income. They were told to buy permanent life insurance because it was an investment and good for the rest of their life. They questioned the person who sold them their policy when they saw they were almost paying $1,000 a month. But the person who sold them the policy reassured them that they were doing the right thing and that canceling the policy would be a huge mistake. When we dove in and took a magnifying glass to their situation, we determined that their actual need was income protection during their working years, not lifelong coverage. The insurance didn't align with their goals. It was slowing everything else down. After reviewing their situation, the coverage was restructured around term insurance that matched their actual risk window. They remained fully protected, but their monthly premiums dropped dramatically. That freed up cash flow to accelerate things like debt payoff, increase in investing, and it provided them with greater flexibility. We were able to match them with the actual protection they needed, and their overall financial plan gained momentum. Now, I do not know the exact reason why the person they initially spoke to sold them a permanent life insurance policy, but when an agent sells a permanent life insurance policy, the commission is significantly larger to the agent than when selling a term life insurance policy. That large commission is often a factor in why some insurance agents push high premium, excessive protection policies onto people. Not all insurance agents are that way, but it's a good thing to know when meeting with one as they evaluate your situation and come up for a plan for you. One important concept is that insurance needs are rarely permanent. As people age, debts tend to go down, assets tend to go up, and dependents become independent. Your reliance on insurance naturally decreases. A good plan anticipates this instead of locking you into high premiums indefinitely. For example, let's think about a home mortgage. Over a 30-year time frame of making payments on it, the equity you build up on your house goes up and up, while the amount of debt you owe shrinks and shrinks simultaneously. Another example is you will owe less money on the house after 15 years than you will after 5 years if you keep making your payments month after month. If you have kids, that's another great example. 2-year-old Timmy is defenseless right now and needs you and your spouse to provide everything for him. But when Timmy is 40, good luck trying to provide any of those basic services for him that you did when he was 2. His need for your support has diminished greatly. Therefore, your need for insurance coverage has diminished as well. At Hendricks Wealth and Estate Management, insurance is never evaluated in isolation. It's coordinated with cash flow, debt strategy, investing, and estate planning, all while taking into account your specific situation regarding whatever stage you are at in life. The goal we strive for is to have every dollar work together towards the same outcome. Insurance should support your plan, not replace it. Anybody who tells you otherwise is likely trying to sell you something you do not need. Here's just a quick recap of the major points we covered today. Insurance should protect your family, not drain your resources. When coverage is intentional, appropriately sized, and aligned with your goals, it creates peace of mind without slowing progress. Today's presentation was educational. There's no obligation to take any next step. If you feel confident in your coverage, that's great. If you'd like help reviewing what you already have or getting a second opinion, that's available. I am a life insurance agent, and so is Jim Hendricks, and so is Tom Anderson, who's on this call. We would be happy to sit with you, talk about your coverage or lack thereof, and determine if your current plan is a good fit for you. With that, I'll say thank you for your time today. That concludes the presentation part of this webinar. And at this time, I'm happy to field any questions anyone in the audience has.
That was excellent, Dan. And while we're waiting to see if there's any questions from anyone in attendance, Wanted to go through the next couple webinars. Again, as Dan alluded to, we do these on a weekly basis at 11:30 Central, 12:30 Eastern. And next week, next Wednesday, Tom Anderson will be speaking about the 7 most common 401k mistakes and how to fix them. On May 6th, we'll have a take two on a Medicare 101 session with a guest speaker, Joshua O'Brien, who's a Medicare representative or a consultant on Medicare. So he'll be speaking to Medicare issues. On May 13th, I will be talking about old 401ks and how it can be costing you more than you think. And then on May 20th, Dan will be up again speaking about the 3 biggest lies keeping people from getting ahead financially. And Dan, thank you for an excellent job. I don't see any questions coming in, so if you want to take us out, that'd be great.
All right. Well, thank you, Jim. I appreciate you updating everybody on the presentations we have up and coming. Exciting stuff. We hope to see you all there. And I will say, well, once again, thank you all for tuning in today, whether you're watching this live or watching this video as a playback. And we look forward to hopefully hearing from you soon and seeing you at one of our future webinars. Have a great day.
Take care, everyone.